Hello everyone. If you're learning about investing, you've probably heard the term bull market used in conversations, headlines, or financial news. It's often associated with optimism, growth, and rising prices, but the term itself is rarely explained in a clear and practical way. For beginner investors, this can lead to misunderstandings. Some people assume a bull market means investing is easy. Others believe it means risk no longer exists. In reality, a bull market is more than just that. In this video, we're going to clearly explain what a bull market is, why it happens, how it affects investors, and what it means for long-term wealth building. The goal is not just to define the term, but to help you understand how bull markets fit into investing as a whole. By the end of this video, you'll have a clear, confident understanding of bull markets and how to think about them as an investor. So what is a bull market? A bull market refers to a prolonged period during which prices rise across a broad portion of the market and investor confidence is generally strong. A common guideline is that a bull market begins when prices rise 20% or more from a recent low, but the exact number is less important than the overall trend. What truly defines a bull market is a sustained period of optimism. Investors believe that economic conditions will improve, businesses will grow, and future outcomes will be better than current ones. Prices rise because expectations rise. So why is it called a bull market? The term bull market comes from the way a bull attacks, which is by driving its horns upward. This imagery represents rising prices and upward momentum. Over time, the term became shorthand for periods of growth and optimism in financial markets. While the name itself is symbolic, it helps describe both the direction of prices and the emotional tone of the investing environment. So what causes a bull market to begin? Bull markets usually begin when conditions improve after a period of uncertainty or stagnation. Common factors that contribute to the start of a bull market include economic recovery or expansion, improving corporate earnings, supportive financial conditions, technological or business innovation, and increasing investor confidence. Bull markets don't typically start with widespread excitement. They often begin quietly, while skepticism is still present, and gain momentum as positive results continue. So how is a bull market different from a short-term rally? Not every increase in prices qualifies as a bull market. Short-term rallies can occur at any time, even during periods of uncertainty. A bull market is different because it reflects sustained growth over an extended period, not a temporary rebound. Bull markets are characterized by long-lasting upward trends, broad participation across sector, improving fundamentals, and growing confidence over time. The difference is persistence, not just direction. So how long do bull markets usually last? Bull markets can last for varying lengths of time. Some persist for a few years, while others last much longer. There is no fixed timeline, and no clear signal that marks the exact beginning or end. What matters is understanding that bull markets are phases, not permanent conditions. They reflect periods of growth that eventually slow or change as conditions evolve. So why do bull markets feel encouraging to investors? Bull markets feel encouraging because progress becomes visible. As prices rise, confidence grows. Positive outcomes reinforce belief in investing, and uncertainty feels more manageable. However, this encouraging environment can sometimes lead investors to underestimate risk. Confidence can quietly turn into complacency if discipline is lost. Bull markets reward patience, but they also test judgment. So how do bull markets affect investor behavior? Bull markets influence investor behavior in powerful ways. Common responses include increased risk-taking, overconfidence in decision-making, chasing investments that have already risen, and ignoring potential downside risks. These behaviors often feel justified during periods of growth, but they can lead to poor decisions if investors lose perspective. So do bull markets mean investing is easy? Bull markets can make investing appear easier than it actually is. When prices are rising broadly, even poorly planned decisions may seem successful. This can hide mistakes and create false confidence. A strong market does not automatically mean a strong strategy. Bull markets reward participation, but they do not eliminate risk. So why do bull markets tend to follow periods of decline? Bull markets often follow periods when expectations are low. When pessimism fades and conditions stabilize, prices begin to reflect improving outlooks. As confidence slowly returns, growth accelerates. This pattern reflects the natural rhythm of markets adjusting to changing realities over time. So do all investments benefit equally during bull markets? Not all investments respond the same way during bull markets. Some benefit significantly from growth and optimism, while others provide steadier, slower returns. Different investments react differently depending on their characteristics and sensitivity to economic conditions. This is why portfolio structure and balance matter. So how do long-term investors approach bull markets? Long-term investors appreciate bull markets, but they remain disciplined. Rather than chasing excitement, they focus on staying aligned with long-term goals, maintaining balance, avoiding emotional decisions, and letting growth compound over time. Bull markets are opportunities to stay consistent, not to abandon strategy. So why do some investors underperform during bull markets? It may seem counterintuitive, but many investors struggle during bull markets. Overtrading, excessive risk-taking, and emotional decision-making can lead to poor timing and unnecessary losses. Bull markets reward patience and discipline more than constant action. So how do bull markets contribute to long-term wealth building? Bull markets are where most long-term growth occurs. Sustained price increases allow capital to grow, compounding to work, and long-term strategies to succeed. Missing extended periods of growth can have a meaningful impact on long-term financial outcomes. So why do bull markets eventually end? Bull markets don't end because growth suddenly stops. They end when expectations change. When optimism outpaces reality, conditions adjust. Growth slows, confidence shifts, and prices respond. The end of a bull market is rarely obvious in real time, which is why predicting it is so difficult. So how should beginner investors think about bull markets? Beginner investors should view bull markets as opportunities for growth, tests of discipline, normal phases of investing, and reasons to stay consistent. The goal is to participate thoughtfully, not recklessly. So how does volatility exist during bull markets? Even during periods of growth, volatility remains. Prices do not rise in straight lines. Pullbacks, pauses, and uncertainty still occur. Understanding this helps investors avoid overreacting to short-term movements during otherwise positive environments. A bull market is a period of rising prices, growing confidence, and expanding opportunity. But it is not a guarantee of success, and it does not remove risk. Understanding bull markets allows investors to appreciate growth without becoming complacent. It encourages participation while reinforcing the importance of discipline and long-term thinking. When investors understand what a bull market truly represents, they can approach investing with clarity, confidence, and perspective, regardless of market conditions. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and check out our channel for more amazing videos that can help you grow your investment portfolio.